Hey, imagine you're in a crowded elevator. It goes up, but suddenly stops at a certain floor and drops back down. Then later it falls and magically bounces right back up at another floor. That's exactly what happens in the stock market every single day. Today, I'm going to show you the two invisible forces called support and resistance that control where prices stop, reverse, or explode. And by the end of this video, you'll start seeing these levels on every chart you look at. Let's dive in. Whether you're a complete beginner or have some experience, understanding support and resistance is one of the simplest yet most powerful skills in trading. Big institutions, hedge funds, and smart retail traders all watch these levels, ready to see how prices don't move randomly, but dance around these invisible lines. Think of support as the floor of a building. It's a price level where falling prices often stop and bounce back up. Why? Because enough buyers step in, thinking this is a good deal. Resistance is the ceiling. Prices rise and hit this level, then often get pushed back down because enough sellers say this is expensive enough, time to take profits. These aren't random numbers. They're created by human psychology and real buying/selling pressure. See how the price respects these levels? It's like the market has memory. Let's look at some real examples so you can see this in action. Look at this chart. Every time the price dropped to around this level, buyers stepped in aggressively. It bounced multiple times. That's strong support. Here, the price kept hitting this upper level and falling back. Sellers were in control at that price. Classic resistance. Here's where it gets really interesting. When the price breaks through support, that level often becomes new resistance. And when it breaks resistance, that old ceiling often becomes the new floor. This role reversal happens all the time, and spotting it early can give you a huge edge. So how do you actually find these levels? 1. Look for areas where price has reversed multiple times. The more times it bounces, the stronger the level. 2. Round numbers often act as magnets, like $100, $500, or $1,000. 3. Previous highs and lows are natural support/resistance zones. 4. Volume helps. Levels with high trading volume in the past are usually stronger. Pro tip: don't draw too many lines. Focus on the most obvious ones that the price has clearly respected. What happens when price breaks these levels? Break above resistance equals potential big move higher, bullish breakout. Break below support equals potential drop, bearish breakdown. But beware of fakeouts. Sometimes price breaks a level only to reverse quickly. Always wait for confirmation, like a strong close above the level with good volume. Imagine catching a move like this. That's the power of understanding these levels. Biggest beginner mistake? Treating these levels as exact prices instead of zones. Markets are messy. Treat them as areas, not perfect lines. Also, combine them with other tools like trend lines or moving averages for even better results. Support and resistance are the foundation of reading price action. Once you start seeing them, the charts suddenly make a lot more sense. The market isn't random. It's a battle between buyers and sellers at these key levels. Drop a comment. What's one stock or chart you're going to check for support and resistance today? If you found this helpful, hit like, subscribe, and turn on notifications. In the next video, we'll look at how to actually trade these levels with real strategies. Thanks for watching. Now go look at some charts and start spotting those floors and ceilings. See you in the next one.